Hi, everybody, and welcome along to the Mint Monthly Update for the single sector funds. Today, you have myself, David Fyfe, joining with John Middleton, the portfolio managers of the two funds, and we'll walk through the month of May that was. And just starting on a couple of themes and a couple of pieces we're monitoring at the moment. Of course, it's been quite topical, really. It's been the cyclical recovery of the New Zealand macro conditions or lack thereof, but also just looking at the cyclical sectors within the 50. Now, I thought a couple of pretty telling charts, looking on the left there, really around the earnings of some of these names. Now, we do know that it has been a tough cycle, in terms of when had higher interest rates and also just the cost inflation kicking through. But if you look on the left with HPI, domestically, and other impacts, the cyclical earnings of a couple of names in particular have been challenged. Now, starting in the top left there, you can see Fletcher Building. Now, the three different colours are just for the next 3 years of analyst forecast, but clearly you can see from an EPS perspective, it's almost halved over the last couple of years in terms of expectations, in terms of future. So very much the recovery over the next couple of years has continued to be pushed out. Similarly, another interesting one below is main freight. Now, it's obviously slightly different exposure, but certainly still locally as well as Australia, but a bit more global. But even then, you can see some pretty severe earnings expectation cuts across the board. So I guess really why are we thinking that? We're just trying to get confidence in outcomes of the market as well as the economy. But when you see that the earnings are forecasted sort of more than halved, I guess the next question is, well, now what are we paying for those? And is it time to get excited or not? Clearly, things like the Iran war, inflation around fuel, etc., have played a big impact. But on the right there, we're looking at where are people hiding at the moment? What are people paying more or less for? And realistically, interesting to see that cyclical is the green line on the chart, sort of around its norms. Obviously, norms for a multiple, but again, we're saying based on a lower earnings trajectory at the moment, so therefore probably not too bad place. But where we see things stretched and where have people been hiding, clearly the red line across the top there is defensives, now obviously trading at a higher multiple than traditionally it has. We do know that some sectors like the Gentile is doing particularly well in the defensive space, but people really are paying up for some of those. So I guess from our consideration on portfolio construction, we are starting to think about, is it time to allocate more to some of the cyclicals, and again the structural growth names as well, having a look at, which is our traditional stomping ground. But in terms of the funds themselves and the benchmark, the 50 had a strong month, up over 2.5%. And it was driven largely by a few of the larger caps in town. We saw Infratil was clearly a big driver of that. And again, there were a couple others too, and things like main freight that had a nice wee recovery too. And again, it was the mid caps and small caps sort of were left a little bit behind, but it was a pretty volatile, and we saw some pretty big swings within the wider market. We also had a reporting season too, which helped drive a lot of updates. And it was interesting in general. There weren't huge amounts of giant beats, but in terms of share price movements post the fact, we did see some pretty positive outcomes, almost reflecting that chart I showed you earlier, which is that with earnings and expectations a lot lower, the chance to beat and see a bit of upside in share prices has a little bit higher. In terms of the fund itself, the positives you can see on the left there, three rather large numbers in terms of the share price moves. It's not often you get 20% plus move in three names across the fund, but it certainly was helpful, and the fund had a cracking month, almost 200 bips ahead of the benchmark. Now, Infratil has been a long-term position in the fund that we've probably talked many times about and had high conviction in, and showed over the month of May that it was a particularly good month. And so we've got a good update from them around their CDC business earlier in the month, and obviously had the result later. And I thought an interesting piece here, just to show the context of what's happening to that business, is really this chart that was put in their presentation pack around the earnings of the business. Now, it does take time to compound up. These are long-dated contracts that the data centers are signing, like CDC. And you can see there that 392 in the middle is the current EBITDA for the business. But in less than 2 years, we're seeing that go to over 1 billion Aussie dollars. So it's a pretty material increase. And this is largely contracted already, so the confidence in this is very high. And the size of the recent contracts has meant that this business will be over 2 billion of EBITDA within a year or two after that. So some serious growth there for a business that's done particularly well for Infratil. And in terms of the thematics that we like within that business, obviously data centers and AI infrastructure is a key piece. The other one is renewables, and again, long road some of the other businesses are going to strength. And in fact, the more and more we talk about both AI infrastructure and renewables, the more we see them as hand in hand around grid connections, power availability. These are very topical pieces and ones that the Infratil guys seem to be well over within the regions they operate, whether it be the US or Australia, alongside CDC. So continuing to be a solid outcome there. In terms of Vista Group, not one that really reported, but one that did have a few very positive updates, which saw a massive de-risking in a name that's suffered like a lot of businesses in the software and SaaS space. From Vista, we did see a couple of ones out of LATAM, which was one of the large Sinopolis businesses, sign up to move to their full digital program in terms of cloud offering. And that's one that was a great endorsement of the product they've been developing by Vista. But a really interesting one was actually one called Cinemex, not quite as big as Sinopolis, but was one that actually went out on their own to try to recreate and go off on their own to do the software equivalent of what Vista were providing them. And within a couple of years, they've turned around and come back and actually signed up to their product again. So I guess what that means is, in the world of AI, where everyone thinks that software can be recreated quickly, it isn't just as easy as being able to create software. It's the regulation, it's the moats around what's happening, and all the sign-offs in different jurisdictions they operate too. So I think that's a really great endorsement of the product that Vista offer and the market they operate in. So that was great to see from there. And a really interesting one that's topical and in fact hit right on the last day of the month was actually Tourism Holdings. It's been a sort of, I guess, a dormant position in the fund for a while. It's not been an easy time for motorhomes and RVs around in terms of the sales, because they're often linked to interest rates, which are sort of heading north. But what we did see was a second bid come in from a consortium that we had seen a while back on the name, considerably higher at $3.10 from BGH Group, a private equity firm that's played in New Zealand before. They actually took out Pushpay, a name you might know. And with one of the family members that had some equity within the THL business post the Apollo transaction in Australia. So that's one at the moment that's the board is considering, and whether they let them in for DD will be an interesting piece. But it certainly saw a bit more value prescribed to the share price that had been sort of been sitting pretty weak for a long time. And in terms of other names in the fund, EBOS we struggled a little bit with over the period. We've been trimming into strength from Infratil and Meridian as well, as we sort of move some positions around, as we add a bit of Mercury to the fund. So overall, really strong month for the fund, and again, a lot going on. I'll now pass you over to John to talk about the Australasian fund.
Thanks, Dave. Yeah, moving across to Australasia. Again, solid month for the fund, ahead of benchmark. And echoing Dave's comments, really, NZ did pretty well. Unfortunately, a little bit of the growth side of Australia gave back. So, but solid month for the fund. And I'd say in general, the mini reporting season we had in NZ in May was better than feared. I mean, we had Mainfreight, Fisher & Paykel Healthcare, and Infratil reporting, as well as Ryman, and for the most part, everything went in the right direction, probably ahead of expectations rather than in line. So, a bit of recovery in the market from that. Dave's covered off the main names on the New Zealand side. I thought I'd talk a little bit about the two healthcare names, but basically moving in opposite directions. So, Fisher & Paykel Healthcare delivered results. Let's say there's a certain amount of trepidation heading into that number. And again, the number proved to be very good, certainly at the top end of expectations for the current year, which was basically expected. But the guide for 2027 was also pretty solid, double-digit growth and a solid outlook, which allayed a lot of market concerns. And we had a bit of a bounce. I suppose the main focus of concern was really, the oil price and oil-related impact, particularly looking at resins, which is a major part of the consumables that they manufacture, and also freight rates in terms of getting the product, but a lot of the time out of New Zealand, but also out of Mexico into the US and elsewhere. So I think they dealt with those issues pretty well. And the interesting thing is that the rolling back of tariffs probably gives them a bit of a tailwind over the next 12 months or so. I wouldn't necessarily bank that, because clearly something else might happen. But I think there was a certain amount of relief from the market on the back of that announcement. The picture on the right gives you a summary of the hospital business. Essentially, they give people humidified air, which helps you breathe when you're in particularly difficult situation with the respiratory tract. I just flag a few things from the chart or the slide from the presentation. First of all, just the growth rates. Most of the businesses are growing at double digits and high double-digit rates. We do focus a lot of the time on consumables, which is what the lady is having around her nose and the pipe towards the machine. That business has grown 15% compound for probably a decade. I'd also flag the columns at the bottom. I mean, this is the revenue of the business over time. And I suppose the interesting thing here is it does show you that essentially we've got a very, very strong 2021 on the back of COVID, where revenues basically doubled. And obviously since COVID, there's been a gradual decline in that business as things have returned to normal. But the thing I would flag was 2026 revenue actually exceeded 2021. So notwithstanding the downturn or the recovery from COVID and things going back to normal, the Fisher & Paykel Healthcare business has really moved on. And I think that the key thing for me from this result was not so much the consumable side of the business, but hardware, i.e. Airflow 3, which is essentially humidification that you can move around with you, and also the humidifier, the 950. The last probably year and a half, we have seen significant volumes of hardware being sold globally, really, not just the US and Europe, but also into emerging markets, particularly Asia. And for me, this is the really interesting thing about Fisher & Paykel. Great business, doing very, very well. Certainly COVID, I think, demonstrated the benefit of giving people humidified air when they're having breathing issues. And certainly the sale, the significant volumes of hardware sales would imply that actually we are starting to change clinical practice, and rather than just use these products in the ED or in specialist respiratory wards, we are actually potentially selling them to the wider wards in the hospital, which does set up Fisher & Paykel for medium-term growth. So good results, solid outlook, and again, a business doing well. I would also just touch on EBOS. Again, to be honest, moving in a slightly different direction. Really, I think a lot of sort of the negative sentiment towards EBOS really comes from losing the Chemist Warehouse contract a year ago now. I think that's fully factored into numbers. And again, was it a real market loss? No, I think Chemist Warehouse decided to merge with a competitor and took their business elsewhere. Technically Chemist Warehouse is also in New Zealand and is likely to source its own logistics here going forward as well. But clearly, that's a little bit of a headwind to the stock. And to be fair, we had an investor day which didn't really tell us anything new or really catalyse the story. This is a business with a great reputation for M&A and growing mid to high single digit over the medium term. New management has come in and sort of echoed those sentiments, but really we need to wait for them to prove that they can deliver in the way that previous management did. And the reality is, I think it's just a bit of a waiting game. We'll need to see a couple of sets of results to really fully believe the new management team. So again, we've trimmed a little bit, but fundamentally, I think the business is fine and at an attractive valuation. Within the fund, we added a little bit of Rio Tinto and Southern Cross Electrical and funded that through taking a bit of profit out of SRG and Challenger. Moving across to the property fund. Again, a decent month for the property fund as well, and again, slightly ahead of benchmark, which was good. We did get a mini reporting season from the property sector, and the good news there was most of it was in line with expectations. When we looked at it, the good news was we got solid rental growth, I think, across the sector, certainly low to mid-single digit, which was encouraging. But the flip side was a lot of that growth was basically offset by interest and particularly maintenance capex being a little bit higher than expected. So cash flow was broadly in line. And on the back of that, I'd say that dividends, as we talked about, are sustainable at current levels, but there's limited upside, I think, from here. Looking at the detail, again, it was a little bit interesting to see Argosy increasing asset values despite rising vacancy levels, while Stride, which is a similar situation, was still trimming those asset values. And again, with Argosy, we got the ongoing saga of the dividend, and the reality is they're overpaying the dividend, but they won't stop doing that until management changes. But overall, it was fine. And again, a nice earnings season to have, basically results in line with expectations. The good news, I would say, is that management have taken the opportunity to renegotiate some of their bank covenants and lock in interest rates where they are. I suppose the bad news is we are seeing a little bit of weakness in the New Zealand economy, which is raising questions going forward. So hence the two charts on the right. First of all, vacancy. This is all the companies that reported, so not the whole sector, but it gives you a fairly decent view of the underlying businesses. For the most part, I mean, vacancy over 90, occupancy over 90 or 95% in certain areas means, life is fine broadly for the market as a whole. And again, when you dig into that, prime is in good shape. And certainly the lower quality side of things, where, to be honest, the listed companies don't have a huge amount of exposure, it is where the pressure is. And again, within the listed names, it was really Argosy and Stride that we're talking about. And as you saw there, Stride actually saw some vacancy improvement, letting up a couple of properties, both next to Vero, but also down in Wellington, whereas Argosy saw some vacancy, particularly as it had new capacity coming on with no tenant so far. As we've talked about in the past, the only thing I would flag is Wellington. It remains tough. There is capacity there, and again, the names involved are struggling to get that let out. And clearly, further cuts to government don't really help that scenario. But I'd say for the most part, vacancy remains at manageable levels, and certainly from a cycle perspective, near cyclical highs. The other thing I just flag is the bottom right-hand chart, and this is just looking at interest over time and the hedging thereof. And the reality is, good news for the companies. Even though we expect interest rates to rise over the next year, 2 to 3 cuts baked in already, most of the sector has taken advantage of low rates to lock in interest medium term, and so we won't see a material change in interest rates for most of those companies. Yes, the interest charge might rise a little bit on high debt, but fundamentally, there's not a lot of change there, and hence we still see the dividends as sustainable at current levels. So, a solid reporting season, few surprises. Within the funds, we continue to add a little bit to the high quality side of the market, and again, with a few concerns starting to hit the industrial side, we've taken advantage of what we consider, slightly more attractive valuations there to buy a little bit of industrial exposure. And again, we've taken a little bit of money out of Goodman in Australia and Precinct. Anyway, hope that is of interest. As usual, if you have any questions, please drop us a line at info@mintasset.co.nz, and we look forward to talking to you in a month's time about what happened in June. Appreciate your support. Thanks.